A slew of economic data have been released yesterday, and much awaited Q2 GDP numbers are out. Now, the second quarter or Q2 refers to the months of July, August, and September. Now, after seeing double-digit growth of 13.5% in the first quarter of the current fiscal year, India's GDP expanded by 6.3% in the second quarter of fiscal year 23. Now, the normalization of the base effect and surprisingly a decrease in the output of the manufacturing sector were the causes of the slower growth compared to the first quarter. Now, this shows how rising interest rates and rising raw material costs are beginning to hamper manufacturing growth. The total expansion of GDP was also hammered by a decline in net exports in Q2 compared to a year-ago level. However, despite global growth and financial difficulties, the economy showed sequential rebound and solid growth over pre-pandemic levels, that is Q2 fiscal year 20. Now, when compared with the pre-pandemic period, GDP has recorded a growth of 7.6% with a broad-based recovery across sectors. Now, India's economic activity has held up pretty well in the first half of fiscal year 23, benefiting from domestic macroeconomic buffers. Pent-up demand, especially in urban areas, a rebound in the services sector, and festive season spending were the main drivers. Now, going forward, we believe further improvement in consumption, decline in commodity prices, the government's continued focus on capex, and improved agriculture growth will support GDP growth. Now, having said that, if India needs to grow at a sustainable annual rate of 6 to 7%, that is widely expected, we do need more policy efforts and favorable global macro conditions. Now that we've looked at the GDP number, let's also take a look at how the central government finances are shaping up. Fiscal deficit is the difference between the total expenditure and revenue of the government. In other words, it is a shortfall in the government's income compared with its spending. Now, the centre's fiscal deficit in October touched 45.6% of the full year budgeted estimate. Now, in the corresponding period last year, the deficit was 36.3% of the budget estimate of fiscal year 22. There was particularly a sharp increase in the fiscal deficit in October, which was due to total receipts staying flat while expenditures surging. Now, capex, which has multiplier effect on the economy, also shot up more than 50%, accounting for about 55% of the budgeted target. Now, with more than half the fiscal year already completed, the fiscal deficit for the entire year is still less than 50% of the budget's target. Now, as of right now, the centre's finances appear to be in good shape. Now, given the risk posed by global uncertainty, we do think that managing the government's expenditure side could become challenging as a result of greater subsidy outlays. However, the centre is likely to achieve its 6.4% GDP yearly target. Now, due to this year's high rate of inflation, the nominal GDP, which serves as the numerator for fiscal deficit ratio, is likely to be greater than the budget's 11.1% estimate. So what does this news mean for you? Despite global headwinds, India's Q2 data showed us that Indian recovery is on track, backed by momentum in private consumption and rebound in the services sectors. This will have an indirect positive impact on you. While managing expenditures could become challenging, but so far the government's finances seem to be in order. This will have an indirect positive impact on you. While I say this is me, Merlin Susanna signing off. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.